Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of today's discussion is the Roth 401k versus Roth IRA. Which one builds more tax-free wealth in the 2025? So Roth 401k versus Roth IRA, we will discuss their main differences and how they will work in 2025. So taking its overview, both Roth 401k and Roth IRA individual retirement accounts offer you the ability to save and generate tax-free wealth in retirement. Both Roth 401ks and the Roth IRAs share similarities such as tax-free earnings, growth, and tax-free withdrawals in the retirement. So, however, 401k offers employer matching and have higher contribution limits versus Roth IRAs. On the other hand, you have more investment options with the Roth IRA, while Roth 401ks only allow you to invest in the funds offered by a plan sponsor. Whether a Roth 401k or a Roth individual retirement account best fits you need depend on the financial goals, income, age, and when you want to start withdrawing your nest egg. While both have advantages and disadvantages, discover the key differences between a Roth 401k and a Roth IRA and how these accounts can help you save for the retirement. So, what are the key takeaways in this article? The first one is a Roth 401k has higher contribution limits than the Roth IRAs and allows employers to make matching contributions. A Roth 401k is overseen by your company, which selects the broker and may limit investment options. The second option is a third one is a Roth IRA offers more investment options and early withdrawals of contributions than comes Roth individual retirement accounts. IRAs have been around since 1997. Roth 401ks began in 2001. So Roth 401k created by the Economic Growth and Tax Relief Reconciliation Act of 2001. Roth 401ks are hybrid, blending many of the best parts of traditional 401ks and Roth IRAs to give employees a unique option when planning for retirement. So discussing it more, like traditional 401ks, contributions are made directly from an employee's paychecks and the employers may match part of those contributions. Unlike traditional 401k plans, you pay income taxes on the money before depositing it into the account, meaning you receive no upfront tax benefit in the year of the contribution. In return, you will not pay income taxes on the Roth 401k withdrawals in retirement. So, when we will discuss the Roth IRA, like a Roth 401k, you found Roth IRAs with the after tax dollars, making qualified distributions tax free. Roth IRA offers more alternative investment options than the Roth 401k allows. So, however, a Roth IRA is not sponsored by your employer, and you will not receive any employer match, but you can continue investing in the same Roth IRA even after you change jobs. Individual can select the financial institution or a broker to hold their Roth IRA and investments. You also determine how much you want to contribute each year. Roth IRAs were established by the Taxpayer Reliefs Act TRA of the 1997 and named for U.S. San William Roth of Delaware. So, what are the key differences? Both Roth 401k plans and the Roth IRA plans use after tax dollars, meaning that the owner and does not have to pay income taxes when they receive distributions, making this advantageous to to those who expect to earn more money later in life. However, several key distinctions exist between a Roth IRA and a Roth 401k plan as shown below. First of all is the income limits. Roth IRAs come with an income limit per the Internal Revenue Services and the Internal Revenue IRS and the individual taxpayer with an adjusted gross income AGI of over 1,061 $1,61,000 in 2024, or married couple filing jointly who made over two lakhs and $40,000 in 2024 are not eligible for the Roth IRA contributions. The absence of an income limit gives a Roth 401k a significant advantage over a Roth IRA. In other words, even those with the higher income can still contribute, which pairs well with the Roth 401k's higher contribution limits. The required minimum distribution for the traditional 401ks and the IRAs. If you hold a traditional 401k or the IRA, you must take required minimum distributions by a certain age. As of 1st January 2023, the passage of the Secure 2.0 Act increased the age of the begun RMDs on the other retirement accounts from 72 to 73 for individuals born between 1951 and 1959, and the age 75 for those who born in 1960 or later. Failure to meet your RMD during the year may subject you to financial penalty of 25% of the shortfall. However, if you correct the mistake promptly, the penalty drops to 10%. The only circumstance to defer taking RMDs is if you still employed or not a 5% owner of the company sponsoring the plan. Then comes the required minimum distribution for the Roth 401k and the IRAs. So when we discuss about the required minimum distribution RMDs, first of all we will discuss about Roth 401k and then Roth IRA. With the Roth 401k, you no longer have to take required minimum distribution RMDs after 2023. So required minimum distribution is designated Roth accounts in a 401k and are no longer required as of January 1 of 2023. The passage of the Secure 2.0 Act increased the age to begin required minimum distributions on the other retirement account from 72 to age and 73 for the individual born between 1951 and the 1959, and the age 75 for those who born in 1960 or the later. A Roth IRA does not require you to take RMDs, and ever the flexibility gives you the option keep contributing to your account and letting those funds grow indefinitely. You can pass your Roth IRA to your spouse or the descendants for taxable years beginning after December 31, 2023. The Secure 2.0 Act also eliminates the pre-death RMD for the owner of a Roth designated account in an employer 401k and the other retirement plans. Under current laws, required minimum distribution are not required to begin before the death of the owner of a Roth IRA, although pre-death distributions are required in the case of the owner of a Roth designated account in an employer retirement plan. So what are the investment options for Roth 401k and Roth IRA plans? With the Roth 401k, your investment options are limited to those offered by the plan administrator, commonly various types of mutual funds with set expense ratios. A Roth IRA has a much wider range of investment options as you can shop around to see which custodian while and the vehicles carry the smallest transaction and the administrative expenses. So when we talk about the contributions and the contribution limits, the biggest advantage to Roth 401ks is the possibility of matching contributions from an employer. Employers are offered a tax incentive to make them. Employees who participate in the plans can contribute an annual maximum of the $23,500 for 2025. Individuals can contribute an additional 7,500 catch-up contributions in the 2025 if they return 50 years old by the end of the year. Please note, IRA catch-up contributions will be adjusted for the inflation and the subject to cost of living adjustment or cost of living or COLAs. So there is a hitch. Though employers may match your contributions with pre-tax dollars, and when the Roth is funded with post-tax dollars, the matching funds and their earnings will be placed in their regular 401k account. That means you may pay taxes on this money and on its earnings once you start taking distributions. Roth IRAs have a much lower contribution limit, which is about $7,000 for 2025 compared to Roth 401k. In addition, Roth IRAs are self-funded and do not allow for matching employer contributions. So, for the beginning in 2025, the employers will be required to automatically enroll eligible employees in the new 401k plans with a participation amount at least 3% but no more than 10%. The contribution escalates at the rate of 1% per year up to a minimum of the 10% and the maximum of the 15%. So it is important, unlike Roth IRAs and the Roth 401ks have no income limit, allowing high wage earners to contribute the one. So what are the withdrawals limits? So discussing about this topic, the access to the funds in your Roth 401k before the age 59 and half years is limited. Tapping nest eggs before retirement should always be a matter of last resort, but if you must do it, you can't take cash out of your Roth 401k without incurring a 10% penalty. So with a Roth 401 Roth IRA, you can withdraw an amount equivalent to the contributions you have made at any time without penalties or the taxes. However, this does not apply to the Roth IRA's earnings, for which pre-retirement withdrawals, if you are under the age of 59 and half years, still comes with a 10% penalty. However, under the certain circumstances, such as buying a home for the first time or incurring child birth cost, you are allowed withdrawals of earnings from the your Roth IRA free of penalty if you have held the accounts for less than 5 years, and free of penalty and taxes if you have held it for more than 5 years. With the passage of the Secure 2.0 Act, participants can access up to $1,000 annually from retirement savings for emergency, personal, family expenses, and without paying the 10% early withdrawals penalties. Additionally, employees will be able to set up a Roth emergency saving account with up to $2,500 per participant. Survivors of the domestic abuse can withdraw the lesser of the $10,000 or the 50% of their retirement account without penalty, and the victims of the federally declared disaster can withdraw up to $22,000 from their retirement account without penalty. So when we talk about the loans, an advantage of the Roth 401k account is the ability to borrow money against your account balance. You can borrow up to 50% of your account balance or the $50,000, whichever is smaller. So however, if you fail to pay pay back the loan as per the terms of the agreement, that money could be considered as a taxable distribution. Unlike Roth 401 case, Roth IRA doesn't allow loans but do permit a Roth IRA rollover. So during this period, you have 60 days to move your money from one account to another. As long as you return that money to it or another Roth IRA in that time frame, you are effectively getting a 0% interest loan for 60 days. So discussing difference between Roth IRAs and Roth 401ks. For Roth IRA, only those making less than 1 lakh and $65,000 can contribute. Anyone can contribute in Roth 401k. So for Roth IRA, contributing up to $7,000 per year. On the other hand, for Roth 401k, contribute up to $23,500 each year. 31,000 for those who are, or who are 50 years old and the older. So wide range of the investment options are available. Only a few investment funds are available in the Roth 401k plan. On the other hand, so you can withdraw contributions freely, but earnings are taxed at 10% if withdrawn before the age of 59 and half years for the Roth IRA. And if we talk about the Roth 401k, 10% penalty on the withdrawals before the age of 59 and half years is applied. You cannot borrow money in the Roth IRA from the balance unless you execute a rollover. For the Roth 401k, you can borrow up to 50% or the $50,000 from your account balance. Whichever is smaller for the Roth 401k. So can I take a loan from my Roth IRA? Technically no, there is no provision for borrowing against your Roth individual retirement account Roth IRA, only for taking qualified or non-qualifying qualified distributions. However, if you initiate a Roth IRA rollover, you have 60 days to use that money at 0% interest before depositing it in your new account, essentially a short-term loan. Can I have a Roth 401k and a Roth IRA at the same time? Yes, as long as you meet all the income limits and the restrictions, you can contribute to both Roth types at the same time. Mm. The contribution limits for each is different. The $23,500 for a Roth 401k and $7,000 for a Roth IRA in 2025. Both account types can have a catch-up contribution for people 50 and over, and additional $7,500 for a Roth 401k and an additional 1,000 for a Roth IRA in 2025. So can I choose the investment in a Roth 401k? So if we discuss about this topic, because our Roth 401k plan is an employer sponsored plan, your choice of the investment in this plan, in the Roth 401k plan, will be limited as it is visible by that is it is an employer sponsored plan to what the corporate structure had decided. So a Roth IRA, on the other hand, will be simply a tax shelter for a wide range of the investment. So when we talk about the bottom line of the IRA versus the IRS, the Roth IRA and the Roth 401k plan comes with their own perks and benefits. Neither type of the Roth account is inherently better than the other. Many investors may choose to incorporate both into their retirement plans to capitalize on the benefits. So finding a vetted financial advisor doesn't have to be hard. Smart Assets free tool matches you with fiduciary financial advisors. So That was all about the topic. Here we discuss overview, Roth 401k, Roth IRA and key differences. Hope this video will be beneficial for you. So do subscribe my channel for more helpful videos. Thank you.